Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028-201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
It's a little early show today, but it's all good. I don't think anything's really going to happen much over the next few hours that would have impacted the topics of the show. But I do have something I have to do later, so hence the earlier show. But welcome, everyone. Wilmington Mortgage. I am the aforementioned host of this podcast. Tyler Cralle, of course, loan officer at Town Bank Mortgage right here in Wilmington, North Carolina. And what we do on the podcast is we break down the top stories of the day that are impacting rates, and we do it in 15 minutes or less. And like I said, I don't think much was going to change on today because we already got the story. And the story is slowing economy, a weakening economy. Now, we got a bunch of data points, a bunch of different kind of reports that came out, but one story, and that is a weakening economy. And let's start with retail numbers. That was kind of the big report that got a lot of attention. We had that come out at 8:30 along with PPI. Retail sales edged up just 0.2% in November, sharply below the 0.6% pace that we saw in October and half of what economists were expecting. It is the weakest showing since May's decline. May was a negative month. And probably more concerning is it didn't keep pace with inflation. So the latest CPI that we got showed that prices were up 0.3%. So retail sales are not inflation adjusted. So the fact that sales were only up 0.2% means that the prices, the more money that people were spending was more a reflection of higher prices than higher demand. And so that's a problem. What dragged sales in sporting goods plummeted 2.5% for the month. Just in September, online retailers and clothing stores were both down 0.7%. What propped things up, miscellaneous retailers saw a big 2.7% jump, once again, just for the month, followed by gas stations were up 2%, and health and personal stores were up 1.1%. But like I said, the top line number and the fact that that did not keep pace with inflation is a problem. And then, of course, that was followed at 10 a.m. We got a consumer confidence report that was like, so the Conference Board's Consumer Confidence Index tumbled to 88.7, down from 94 or 95.5 in October. This is the lowest reading since April. And economists were only expecting a drop of about 93.5 too. So they're expecting about a 2-point drop. They got almost a 7-point drop. And that April number is important because remember what happened in April was you had the reciprocal tariffs were announced and people were very worried about consumer prices. And so confidence collapsed and then it sort of climbed back, but we are now back to that April low. And it's not so much concern about now, it's concern about the future. While we did see a drop in the present situation index, it was the expectations index, which looks at, consumers' outlook for, their income, business, jobs. That plunged 8.6 points to 63.2. That is now well below that 80 level. Now for 10 straight months, that index has been below 80, which is usually a signal for a recession, that a recession is coming. And so we are now well below that 80 number. And so once again, another sign, kind of adding it all together, and we got some concerns. This, of course, follows what happened last week with consumer sentiment being at the lowest level, I think, since April as well. And then, of course, concern about the labor market is all kind of adding up to people are not feeling great about the economy. And then sort of complicating things, we got producer prices. That came out at 8:30. This is the data from September. The producer price index showed that prices rose 0.3% in September, reversing the 0.1% drop that we saw in August, and is the third largest increase since February. Higher producer prices often, of course, feed into consumer inflation, slowing progress towards the Fed's 2% goal. And producer prices are also a little concerning because, remember, producer prices don't account for tariffs. So they're not including imported producer price increases that we've seen. They're talking just domestically. Now, of course, tariff price, influence manipulation, whatever you want to call it, does find its way in here because when the prices go up for, imported goods, you tend to also see domestic producers going, ooh, we can raise our prices too. Because, those prices are going up. So we're going to raise ours just a little bit as well. So we're still better priced, but why not make a little bit more money? And so it is sort of in there kind of unofficially, but not the same impact that you would see with like a CPI or PCE or something along those lines. But a problem nonetheless. So what we're seeing is a little bit of stubborn inflation, but then on top of it, retail sales not keeping pace with inflation, consumer confidence plummeting to a 7-month low. Other reports showing some concern about consumer sentiment, and then of course on top of it, just concern about the labor market. So, I mean, the verdict is in. The economy is showing signs of slowing down. It is weakening. And then we've also heard, because of the showdown, that we could actually see a negative GDP number in the fourth quarter. That was an argument that was made by White House economic advisor Kevin Hasset. So all signs are pointing to some issues with the economy. And so now all of a sudden that rate cut in December is looking even more likely. The CME Group Fed Watch tool now has a December rate cut at almost 85%. Remember, was it 2 weeks ago, 3 weeks ago? It was like 42%. So yeah, quite the turnaround. And we're seeing bonds react accordingly. The 10-year yield is flirting with a 3 handle. It is just above 4% as I am recording this podcast. I'm going to assume it's going to kind of hold off there. That would mean that we're now down once again, 4 straight trading days of about a 3 to 4 basis point drop. We are now down 16 basis points in just 10 days. And it's finally kind of because remember, the 30-year fixed is based off of the 10-year, but they don't necessarily, they move same direction, but you can see different spreads. So you can see a bigger drop in the 10-year versus what's happening with the 30-year. Today, we got a big drop in the 30-year, according to Mortgage News Daily. They had the 30-year fixed at 6.25. That was down 7 basis points from the previous day. It is now the lowest level since the end of October. So the 10-year and the 30-year have kind of caught up. So we definitely are trending in the right direction. Now, speaking of the Fed, we had Nick Timiraos write a piece in the Wall Street Journal. Nick Timiraos, of course, the Fed whisperer, who was talking about a rate cut and how most of Jerome Powell's colleagues are giving him sort of cover for another rate cut. However, there are likely to probably be a good amount of dissents. Those would be the people who are more worried about inflation than labor. But it's looking very likely that we are going to get that rate cut in December. Now, after that is anyone's bet. That I do not know what is going to be happening, but the bond markets are clearly reacting like that December rate cut is now back on the table and likely to happen. And speaking of the Fed, it should be noted that earlier in the day, Scott Bessent, Treasury Secretary, was on CNBC. He said that he expects Donald Trump to make a decision about who the next Fed chair is going to be before Christmas. And then later the day, Bloomberg reported that White House National Economic Council Director Kevin Hasset, who I just mentioned, is now supposedly the frontrunner to be the next Fed chair. So that's as of now on this, what is it, November... Why is my date not on my phone? 25th. November 25th, Kevin Hasset is looking like the front runner to be the next Fed chair. And I know he's going to want to cut at the December meeting. No doubt about that. He's going to want to cut. And we're probably going to get one. So, all right. Before we go, I do want to talk about some housing data, some positive housing data. And I like that we got some positive housing data, but that was quickly pushed aside because we got also a report from Redfin about the most people taking their homes off the market, or I think that's what I saw. And so that got more attention. But pending home sales actually surprised to the upside in the month of October. This, according to the National Association of Realtors, the pending home sales index rose almost 2%, 1.9%, beating expectations of just a half a point gain. So pretty good. That was the second best month since March. Also pretty good. And was a big improvement from September's barely 0.1% increase. So some good housing data. People feeling better about where rates are. And then, why not? Why not buy that house now with lower sixes? Love to get a 5 handle, but like I said, lower sixes we will take. The month was broadly positive across most regions. The Midwest was the biggest winner with a 5.3% jump in October, benefiting from stronger affordability conditions. That, according to the National Association of Realtor economist Lawrence Yun. The Northeast followed with a 2.3% increase, and the South was up 1.4% as it maintains its dominance as the top housing region. The West was the only region that was in the red, down 1.5%. Regionally, the South's PHSI, which is the pending home sales index, is far ahead of everyone else, almost back to that 100, which is like a normal kind of housing market. 91.4, the Midwest at 77.7, Northeast at 67.2, and the West at 58.3. As I mentioned, Chief Economist Lawrence Yun said in the release, the Midwest shined above other regions due to affordability, while contract signings retreated in the more expensive regions like the West. So, that makes sense. No doubt about it. But also, it's sad too, because, all the disasters the West has had, you would think you'd be seeing more activity there. But I think a lot of people who maybe lost a home or just left and they're like, we're not going back. That's the only way I can think of as to why you would have numbers that bad, despite seeing that many, disruptions in the housing sector. But like I said, this is a pretty positive report. And it got kind of, immediately skipped over because when it comes to housing, no one wants to hear about a rosy housing market. Once again, we're not in a rosy housing market. As I've said many a times, housing's basically been in a recession for like 2 years. We're at, mortgage demand at 30-year lows, existing home sales is 30-year lows. So it's not a rosy housing market. But anytime there's like a good headline, it's either twisted into a bad headline or it's just not really reported. And so because of this Redfin report coming out that, sellers are taking their homes off the market at the fastest pace in nearly a decade, it's like, let's go with that one. That's the one that we're going to run with. But not here, because I'm going to let you know what's actually happening with housing. And of course, more importantly, being Wilmington Mortgage, what's happening with mortgage markets. So even though it's bad news on the economy side, it's kind of good news for at least the mortgage market. Now, a lot of mortgage people do need to be very careful because while it's like, we're seeing some bad data, so that means we're going to get some rate cuts. This labor market concern is also going to be a problem because people lose their job or are worried about losing their job. They're probably not going to buy a house. And so it's like you want like a kind of weakening economy enough to drop rates, but strong enough that your clients are not worried about losing their job. Is kind of is kind of like the perfect storm for loan officers right now. But it looks like the December cut, the more important thing, the December cut is back on the table and likely is what we are saying. All right, we got to go. You guys enjoy your Wednesday. We'll be back here, Tuesday. I think I'll do a show tomorrow. Why not? I'll do a show Wednesday. We got a ton of data coming out tomorrow, durable goods orders and jobless claims. So we'll talk about that. You guys enjoy your Tuesday. And remember, as always, do not wait to buy real estate. You buy real estate and wait.